Ever wonder why the national debt matters to your own personal finances? Well, let's dive in and unravel this mystery together. First off, we need to understand what national debt is. Simply put, it's the total amount of money that a country's government has borrowed, typically through issuing securities like government bonds. Now, you might be asking, why should I care about the national debt? Good question. You see, national debt isn't just some abstract concept that only matters to politicians and economists. It's a real thing that impacts us all, especially when it comes to our personal finances. Here's how. When a government borrows money, it's essentially competing for funds with businesses and individuals in the financial markets. This can drive up interest rates, making it more expensive for you to borrow money for things like a mortgage or a car loan. But the story doesn't end there. The government has to pay interest on its debt, just like you do on your credit card or your student loan. And guess who's footing the bill for that? That's right, it's us, the taxpayers. Moreover, if the national debt gets too high, it can lead to inflation, which erodes the purchasing power of your hard-earned money. In other words, your dollar could buy less tomorrow than it does today. And let's not forget about investments. The national debt can influence the overall health of the economy, affecting everything from stock market returns to the stability of your job. So as we can see, national debt isn't just a government issue, it's a personal finance too. Understanding the dynamics of national debt and its impact on your financial health is crucial to making informed decisions about saving, investing, and spending. Stay tuned as we delve deeper into how national debt can affect your wallet in the following scenes. Now, if you found this information useful, don't forget to hit the subscribe button and share this video with your friends. Understanding the national debt is crucial for everyone, so let's spread the knowledge. And if you liked the video, don't hesitate to give it a thumbs up. Your support is key to us continuing this important discussion, so engage, share, and stay informed. When the national debt rises, so do interest rates. But how does this affect your wallet? Well, let's dive into it. First, it's important to grasp the relationship between national debt and interest rates. When a country's national debt increases, it often leads to a rise in interest rates. This is because the government, needing to finance its debt, issues more bonds. As the supply of bonds increases, their prices drop. Now, bond prices and interest rates have an inverse relationship. So when bond prices go down, interest rates go up. Now, you might be thinking, okay, but how does that impact me? Well, rising interest rates can have a significant effect on your personal finances, particularly when it comes to borrowing. Let's start with mortgages. If you are looking to buy a home, a higher interest rate means the cost of your mortgage goes up. In simple terms, you'll be paying more each month and over the life of your loan. And if you've got an adjustable rate mortgage, your payments could increase even if you're already in your home. Next, consider student loans. Many student loans have variable interest rates. So if interest rates rise, so does the cost of your education debt. Those monthly payments you're making could become larger, leaving less money for other expenses or savings. And then there's credit card debt. Most credit cards have variable interest rates, meaning the rate can change based on certain conditions, like a rise in the national interest rate. So if you carry a balance on your credit card, a higher interest rate can make your debt more expensive to carry. In essence, rising national debt leads to higher interest rates, which can make borrowing more costly for everyone. Whether you're buying a home, paying off student loans, or carrying credit card debt, the effects of a rising national debt can hit your wallet hard. So, it's crucial to understand this relationship and plan your finances accordingly. Rising national debt means higher interest rates, and that can make borrowing more costly for everyone. Inflation is another piece of the national debt puzzle. But what does it mean for your purchasing power? Let's start by understanding inflation. In simple terms, inflation is the rate at which the general level of prices for goods and services is rising. It's like an invisible tax that chips away at the value of every dollar in your pocket. When inflation rates are high, your dollar buys less, and that's what we call a decrease in purchasing power. Now, how does national debt tie into this? Well, when a country like ours runs up a hefty tab, it often tries to pay it off by printing more money. But remember supply and demand from your high school economics class? When there's more money circulating in the economy, each dollar's value decreases, and that's inflation. This inflation isn't just a statistic, it has real-world consequences. It erodes the real value of your wages and savings. Imagine you're saving for a car that today costs $20,000. If inflation is at a steady 2% per year, in 5 years, that same car will cost about $22,000. Your hard-earned savings won't stretch as far because the cost of goods and services has increased. But it's not all doom and gloom. While inflation can be a silent wealth killer, it can also be a sign of a growing economy. Moderate inflation often accompanies economic growth, while deflation can signal an economic downturn. So, it's a bit of a double-edged sword. And it doesn't mean you're powerless. There are strategies to protect your purchasing power. Investing in assets that tend to increase in value over time, like real estate or certain stocks, can help guard against inflation. But here's the key takeaway. National debt and inflation are closely intertwined. As national debt increases, the risk of higher inflation also increases, and when inflation rises, your purchasing power decreases. So, as national debt drives up inflation, your dollar might not stretch as far as it used to. High national debt can also create a more volatile investment environment. But how does this impact your investment portfolio? Let's break it down. In a high-debt environment, governments often borrow more money to finance their spending. This borrowing can lead to an increase in interest rates, which has a ripple effect on the investment landscape. When interest rates rise, the cost of borrowing increases. This can cause businesses to scale back their operations, leading to lower corporate profits. Lower profits can, in turn, lead to a decrease in stock prices. If you're invested in the stock market, this could mean lower returns on your investments. On the other hand, higher interest rates can make bonds more attractive. As rates rise, the yield on newly issued bonds increases, which can lead to higher returns for bond investors. But here's the catch. The price of existing bonds tends to fall when interest rates rise, which could lead to losses if you need to sell your bonds before they mature. Another factor to consider is inflation. High levels of government debt can lead to inflation, which erodes the purchasing power of your investments. If the rate of inflation outpaces your investment returns, you could end up losing money in real terms. Finally, high national debt can lead to economic uncertainty, which can increase market volatility. This means that the value of your investments could fluctuate wildly, making it harder to plan for the future and potentially putting your financial goals at risk. However, it's not all gloom and doom. A volatile market can also present buying opportunities. For instance, if stock prices fall, you might be able to buy shares at a discount and potentially reap the rewards when prices rebound. So, while high national debt might bring some investment opportunities, it also comes with increased risk. It's crucial to understand these risks and rewards when making investment decisions in a high-debt environment. This will help you to strategically position your portfolio to withstand potential shocks and capitalize on opportunities that may arise. So, how can you navigate your personal finances in a world of rising national debt? In an environment where debt is on the upswing, it's more important than ever to observe smart financial habits. Let's start with saving. While it might be tempting to tuck away every spare penny due to fear of economic uncertainty, remember that having a balanced approach is key. It's crucial to maintain a healthy emergency fund. Around 6 months' worth of living expenses is a good rule of thumb. That said, hoarding all your money in a savings account is not the most strategic move. With inflation potentially eroding your purchasing power, you'll want to ensure your money is working for you. This is where investing comes in. Diversification is a time-tested strategy. Spread your investments across a mix of asset classes. Stocks, bonds, real estate, and even certain types of commodities can help safeguard your portfolio against market volatility. Investing isn't without its risks, though. In a high-debt environment, interest rates can be unpredictable. Bonds, in particular, can be sensitive to these fluctuations. So, take the time to understand the risks associated with your investment choices. Now let's talk about borrowing. Although it might seem counterintuitive, there are times when borrowing can be a wise decision. For instance, investing in education or buying a home can be worthwhile long-term investments. However, it's essential to borrow wisely. Keep an eye on interest rates and avoid high-interest debt like credit cards as much as possible. One last tip: stay informed. Keep an eye on economic indicators, policy changes, and market trends. Understanding the broader economic landscape can equip you with the knowledge to make proactive rather than reactive decisions about your finances. Remember, understanding the impact of national debt on your finances is the first step towards making informed financial decisions. Economic policies play a big role in national debt levels, but how do these policies impact your money? Let's start with fiscal policy, which refers to government decisions about spending and taxation. When the government spends more than it collects in taxes, it creates a deficit, adding to the national debt. This might spur economic growth in the short term, but it can also lead to higher interest rates and inflation in the long run, impacting your savings and investments. Next, we have monetary policy, managed by the central bank. This involves adjusting the money supply to control inflation and stabilize the economy. For instance, if the central bank raises interest rates to curb inflation, your loans might become more expensive, but your savings could also earn more interest. Trade policy is another key player. It involves regulations and agreements that control imports and exports. A protectionist trade policy, which imposes tariffs and restrictions, can lead to higher prices for imported goods. If you love your Italian pasta or French wine, you might have to dig deeper into your pocket. And finally, there's public debt policy. This dictates how the government manages its debt. For example, if the government decides to pay off its debt by printing more money, it could lead to hyperinflation, devastating your purchasing power. Understanding these economic policies and their potential impact on the national debt can help you navigate your financial journey. If you know that a fiscal stimulus is on the horizon, you might anticipate higher inflation and adjust your investment strategy accordingly. If a protectionist trade policy is in the works, you might brace for higher prices on your favorite imported goods. So it's not just about keeping an eye on the national debt, it's also about understanding the economic policies that drive these changes. That's why staying informed and proactive is key. So keeping an eye on economic policies can help you anticipate changes that could affect your financial health. We've covered a lot of ground today, diving deep into the impact of national debt on personal finances. We've journeyed through the intricate landscape of economic policies, interest rates, inflation, and investment risks, all intertwined with the ever-present specter of national debt. Just to recap, we started by exploring the direct connection between you and the national debt. We discovered how government borrowing can influence the financial ecosystem you navigate every day. From the prices you pay at the grocery store to the interest rates on your savings and loans, the national debt casts a long shadow on all aspects of your financial life. Then we delved into the intricacies of rising interest rates. We saw how these rates, driven upwards by increasing national debt, can affect your loans, mortgages, and even your retirement savings. Indeed, it's a sobering reminder of how macroeconomic forces can seep into our personal financial health. Next, we tackled the complex world of inflation, unraveling how it erodes your purchasing power. We learned that as the national debt grows, the value of our money can decrease, making everything from bread to houses more expensive over time. In our discussion on investment risks, we underscored the challenges of investing in a high-debt environment. We highlighted how national debt can create volatility in markets, affecting the performance of stocks, bonds, and other investments. Finally, we looked at strategies to navigate your finances in a world of rising debt. We explored ways to protect your savings, manage your investments, and plan for the future amidst these economic challenges, reinforcing the importance of understanding the connection between national debt and personal financial health cannot be overstated. This knowledge equips you to make informed decisions, safeguarding your financial future in an era of rising national debt. Remember, knowledge is power, and understanding the impact of national debt on your finances gives you the power to make informed decisions. Subscribe for more financial insights and tips.